and welcome to the Canadian Alternative Investment Forum. And there has been much discussion about global fixed income, looking through these current challenges just highlighted with a longer lens. And joining me to dig into this topic today is Richard Pilosof, founder, partner, and CEO, RPIA, one of the largest alternative asset management firms in Canada. Prior to RPIA, Richard spent over 25 years with RBC Capital Markets, where he served as MD and head of global debt markets. Good morning to you, Richard.
Morning. How are you, Jacoline?
Very good. There's a lot of ground we want to cover. So to start, perhaps we can get you to walk us through what is happening in the global fixed income landscape from a macro view. It used to be that fixed income was a very reliable part of portfolio, much like meat went with potatoes, for investors who were seeking yield. And it gave a reliable income. It served as a hedge in bumpy markets. And with today's interest rates, though, this is changing rapidly. Richard, can you go through where we are and how we got here?
Okay. Thank you very much, Jacoline. So I think you've heard some of the comments from David earlier around his views of the assessment of the economy. I think clearly because of the COVID experience, there's clearly been a distortion in what people perceive as the appropriate fixed income return and the appropriate risk-free rate of return that has been readjusted because of COVID. So since policy has changed, when you think about the fixed income and the return attribution, you really have to think about the risk-free rate of return, and the risk-free rate of return now is zero. So from that, what is the appropriate fixed income return profile? And clearly, it's lower. But there's no doubt, in my view, that fixed income still plays an important ingredient and a portfolio mix that has to be in place, even though rates are where they are. We've had the same issue over the last number of years. I mean, since I've been in the bond business, it's been a complete ride down in yields, and here we are, a 40-year bull market, and now we're unfortunately at zero. But there has to be still the same sense of equilibrium and of opportunities, because for every dollar of capital that one looks for new opportunities to invest in fixed income or other alternatives. Could be loans, could be private debt, could be equities that create income. There's another level of risk, or potentially you're taking on a different level of liquidity. So I still think that the purity of fixed income is important and an important part of that portfolio. In terms of the macro landscape, I think David's impressions are similar to mine, that we are going to remain in this environment for the next 2 or 3 years, that the pandemic has transformed in many ways the landscape, and that lower for longer and rates will remain the case, and that you might again have a flattening of the curve, which means that even though you have zero bounds in the short end, you still might have capital gains in 10-year securities and out. So that opportunity in the fixed income market will remain in play, even though the number is getting lower and lower, as it has been over the last 4 years. And the other thing which is important about fixed income is inflation expectations. And I think inflation expectations based on where unemployment is, and based on the fact that we are going to be rolling ourselves through this pandemic, even though if we get a vaccine, this is going to take a number of years to restore the health of this economy. So I don't see inflation as an issue of importance right now. I think it's still going to remain lower for longer.
Great. Thank you. That was very helpful, Richard, in setting the table and for us to see what is at play. It's quite evident that the risks of the pandemic, they're going to continue to stay with us for some time. So this environment for income is certainly challenging. And listening to David, maybe I shouldn't buy that condo in downtown Toronto after all.
But it has to be a smaller condo.
Just a
or you have
one.
to be fast with your feet, yeah.
So Richard, with all the investors that are watching this today, what would you advise them on what they should be doing with their portfolios?
So I think that there's today, in terms of people's perception of, again, coming back to this mix that people talk about, it's the mix is still in play. The use of alternatives, in my perspective, is still an important part of finding ways to create income in ways that may not be correlated to the overall equity or debt market. So searching for active participants in asset allocation, continuing to look for ways to create income or yield or capital gains in ways that are less traditional are going to be very, very important. But as well, I think, which is also very important, is that people be realistic to the expectations of return. If rates are at zero, for every extra unit of risk you're going to take in the marketplace, you're going to take another level of risk. So, for the pure bond market, for example, the corporate bond market, which is essentially liquid, there's a return profile which seems at a spread over above governments. If one's going to buy a loan product or a mortgage product or a direct lending product, and the return profile looks much larger, you're going to take a different level of risk, and that's probably illiquidity. So that distortion has to be well understood, and that perspective of what's the true return profile going forward is going to be lower, and people have to understand that. So, you might get spurts of capital gains in certain asset classes, but the long-term returns and the long-term perspective of what the return profile looks like will be lower. So that's very important, and that has to be, and that means, many foundations or pension funds will have to manage that liability appropriately because the return profile is going to be lower. And that's, I think, to me, the most important part of trying to add return without understanding the risk.
Thank you, Richard. You covered a lot of ground about risk and return there. And it was interesting because one of the fastest growth areas has been ETFs. Richard, investors, they've looked to bond ETFs to get their fixed income exposure. But with passive fixed income investing, are there bear traps? Is there something out there that we haven't seen yet? And could you compare that to, you were mentioning active management. Could you talk about active management around in comparison with the ETFs? And finally, can I add on one other, just to complicate it a little bit more? Why global? Why bring global fixed income? And what does this bring to portfolios?
Okay, so let me answer the first one because most of the investors, the last question first, because that's I think an important question, and I'll go to the ETF thing in terms of how one creates, the creation of that risk or that ability to gain the asset you require through an ETF or through a manager or through either a passive manager or active manager. But in terms of global, you think about Canada itself, and you think about what even David said around the state of the Canadian economy and deficits. The Canadian bond market is very narrow. The Canadian corporate bond market is very narrow. So there are only so many telecoms, only so many safe companies that you can go to create, the return requirements as a Canadian investor. So from my perspective, what we've always looked at ourselves is the ability to buy similar type of companies on a global scale that create the same level of risk profile, but for more yield. So having a global capability is more important today than ever because, again, you're going to run into the fact in Canada, it's a very narrow field of quality companies that can give you that safety. I'm in agreement with David's view of certain companies, especially in the REIT sector, that are going to go through more difficult times, and that's been a very significant area of yield, both from a dividend and from a pure bond yield perspective in the debt market for certain these companies, and many of the retail investors have searched for those. So. And again, those companies might be having a difficult time for the next few years. So global investing is very, very important, more so than ever. When you talk about ETFs, I think when you look at the way ETFs were created, I think they're a perfect instrument for the listed, call it exchange-driven marketplace. they correlate very well. They're able then to create very little distortion and doing things at a very uh, cost efficient way. In the over-the-counter market, which is basically a negotiated marketplace, which are bonds and corporate bonds or government bonds are easy because they're mostly done electronically. But let's look at the corporate bond market. I believe ETFs give people a false level of security. Essentially, in many ways, the underlying securities that encompass the ETF don't trade. So what we saw in March, for example, is that ETFs created a panic in the marketplace because people were selling them indiscriminately without understanding the underlying value of the securities. People thought, therefore, they were liquid, but if you actually understood the so-called discount to market that people were giving up, and some securities based on an ETF trading at 100 and retail clients saying I need liquidity, I need some at 97, that implied an overall yield on some of the securities of 6-7%. So you really have to decompose the value of over-the-counter securities versus what an ETF proposed. So I think they work well for exchange-driven markets. They don't work well, in my view, for the over-the-counter market. So to me, over-the-counter has to be about transparency and has to be about what the securities are in that portfolio and when they trade.
Terrific. Richard, that was a very good summary, very interesting. Let's now talk more about corporate bonds. In March, in many ways, the credit was the fixed point. Could you dive into this deeper? And how is this crisis different from others? How do you see the recovery going forward?
So essentially, I think we know obviously March has been a tremendous learning experience for everyone in terms of how different asset classes behave in a crisis. Let's taking a step back. Before March, the economy was running at a reasonable rate of growth, call it 2% plus, low inflation. And so you were in a very, call it still Goldilocks scenario where you had a accommodative Fed, you had decent growth, and you had return expectations, which were fair based on the risk-free return at that point in time. March created a panic because people's concerns with the economy went from a 2% sustainable GDP growth to all of a sudden a negative 30, and companies were closing, and especially certain types of companies were closing faster than others. So that panic created a need for liquidity. Okay, so like in any situation, you have haves and have-nots, companies that can do well in many circumstances, companies that can't. But the overall issue in March was less about the ability for a company to pay back its debt. Okay, yes, even though, as David says, there's many companies that will have a higher default ratio than currently prescribed maybe a year ago. It was more around the liquidity gap. So ETFs, for example, coming back to that same point, were in desperate need, or people who were sellers of the ETF, of liquidity. Why? Because their equity portfolios were getting sold off very, very quickly, and they needed cash. And that was a liquidity squeeze that occurred. And the biggest area of so-called liquidity was either government funds, money market funds, corporate bond funds, and those were the areas that saw the largest distortion for a very short period of time because they're so-called mark-to-market. It's a very important perspective for all investors to understand that maybe their loan fund or middle market fund or direct lending fund never moved, but the underlying losses could be accumulating without actually a price being transmitted, or that means as well you can't get out. At least in the over-the-counter bond market, there's a transmission process. A price might be wrong for that distortion, but at least it's a price. That's why, as David says, which is not wrong, the Fed came in and had to support the bond market, and they had to support, in most unusual way, the corporate bond market, because it has become an area of liquidity for many, many retail and institutional investors. Remember the crisis from 2008, the transfer of risk moved away from the banks to the investors, which is money management firms. And that's where the central banks, the Fed, saw that to be a significant risk, to the general economy and general level of liquidity that was in people's pockets. Mom and pop who were having to create liquidity for their stock portfolios and for concerns around raising cash through COVID. So, going forward, I think, as David says, the Fed has created a stability mechanism, rightly or wrongly. I think it was rightly. I think, when you had a situation where the market was panicked, they created a stability mechanism. That stability mechanism took 2 years in the '08 crisis to create because of all the different agendas in Washington. In March, it took 2 weeks. Very impressive. The Fed took it on its way to create that stability mechanism. Going forward, like in any situation, like in any investing in any equity, you're going to have dispersion. Dispersion means companies that are going to do well, companies that are not going to do well. So that aspect of finding those companies is going to be even more important, and having that view of so-called active management, finding those little jewels in the rough, are going to be more and more important moving forward, because clearly the environment has changed, and certain companies, maybe like a commercial REIT, may do a lot less well than as an Amazon or an Apple going forward. So those are very important considerations to make moving forward in the investment process.
So Richard, in closing, I want to thank you so much for bringing light to such a difficult subject. And I think also you gave us some lovely nuggets for as investors for our portfolios. I'd like to hand back to Karen Aslan now, who's the founder and organizer of the Canadian Alternative Investment Forum, to take questions from the audience for you, Richard.
Thank you very much, Jacoline. Thank you, Jacoline, very much.
Hi. Well, that was shorter and sweeter than I thought. Richard, what else would you like to say? If you were to think about what you believe is important, you've got 230 people right now listening. What would you say?
Well, I think people asked me, in terms of the experience of March and the understanding of, what are lessons learned from each of these. Like, I've done this for 38 years. And in each circumstance, there are always learning lessons, and there's going to be a new crisis, okay, that's going to occur in the next number of years. The crisis will look different than the current crisis. People are going to ask me questions around stress testing our portfolio against COVID. But in my view, Fed policy, like it was in the '08 crisis, has sorted out the stability of the marketplace in that circumstance, meaning that risk associated to what occurred with COVID and call it a rapid deterioration in price, and for example, in corporate bonds, it was only with 9 days, created an aberration that hasn't been seen since the previous crisis. So what will be learned from the new crisis? It won't be the same. So so we should always ask ourselves, okay, what is a new crisis? How are we going to protect ourselves from that tail risk? Because, the questions will always be around the tail risk that was occurred from the '08 crisis. And then the tail risk will be asked again about what is a tail risk in the COVID crisis. And again, it's one where one has to continue testing themselves about what the new landscape will look like, and it's different, and the investment landscape will be different. The one other thing which is very important, again, which I said earlier, is that based on the risk-free return being zero now, risk-free return being two years ago or a year and a half ago, the investors have to be very careful about how they measure liquidity risk and taking on certain levels of so-called even new alternatives that show a significant yield when the risk-free return has moved so much lower than it was 2 years ago. So if someone's saying that they're going to able to offer you an 8% return, and the risk-free return is 2% lower than it was, a couple of years ago, you have to ask yourself that question again: how are they going to earn that based on the fact that you're probably taking on more risk? Is it liquidity risk? Is it credit risk? Is it security risk? Those elements to me of learning less.
Okay. So when I think about RPIA and when you founded the firm, it's just been such a great success story in the alternative investment world in terms of asset growth and your incredible team and great performance. And you never look forward to seeing these kinds of things happening. I guess my question really is about how you and your team have managed this as an asset management firm managing a lot of capital. What your team has learned from the cohesiveness of the team, what's changed. I see that you're at the office. Some of you are going into the office, some of you aren't. When I think about all of the investors, many of which are probably here, what would you say to some of those points?
Well, firstly, taking a step back beyond just the issues of the crisis, myself and my partners at our RPIA, the premise of what we did early days was not to sort of grow into a large alternative asset manager. That happened a little bit by luck and a little bit by hopefully creating a decent product. But I think creating a culture, a partnership, investing in something that we put our money where our mouth is, and having, in our view, partner money and partner capital behind those things. So to me, in anything or any investment that one looks for, and the audience today, I think that perspective of having partner capital, excellence in operational efficiency, risk efficiency, is always going to be paramount. So, for me, what we did at RPIA was really around something I only done my whole life. So it's not like I had experience in doing equity investing or real estate investing. I'm a bond guy. I understand most aspects of the bond market, and therefore we brought an expertise we thought that was lying as a very profitable experience at banks that we brought to investors. So I think that experience is still going to be excellent going forward. I think that from our perspective, we've learned a lot from March. We had a difficult short-term period in March that created some lessons for us. Never be arrogant, always be honest with yourself. And I think we've done that here. And as a partnership, we're continuing to try to find ways to improve. And that's like personally or professionally, it's life's a long lesson, and we're trying to continue to move on that path for sure.
That's great, Richard. And I think that was important to talk a little bit about your experience of late. And Jacoline, I just wanted to, you're here, and is there anything that you would like to say in terms of how UBS is fitting into this new environment?
Well, it was interesting listening to David speaking about being over in Switzerland, because of course UBS was founded in Switzerland, and a lot of that culture infiltrates all across the world. And just as David was saying, our team had planned for alternative, work from home capability, which they were able to switch on within days. And it was pretty astounding how fast that rolled out. And the other part I find very interesting, again, and Richard was talking about culture, partnership, is I have been astounded by the UBS culture of caring. And I guess I'm a capitalist, I'm a go, entrepreneur, and I tend not to have that side. So it's been a very wonderful experience to be with them. The other part is talking about Zoom, and David and Richard were both mentioning that, was that I find it's so accessible. I'm accessing, ultra high net worth prospects, I'm in sales, who I probably would not have had a chance to meet. Plus, I'm working in Vancouver, Montreal. So it's a much easier way for me because people don't have the expectation for me to be in the room with them. Great. So I think this is a very interesting and new way of working. As an extrovert, I love being out with people, but I have to say I'm much more productive being at home.
Wow.
So, yeah, it's a mixed bag.
Okay.
I'm more of the work from the office type person, and having, especially the investment process, I think having all the people directly looking at you still, old school, there's nothing like that to be able to really see pain in people's face or excitement in people's face to make an investment.
For sure. And Richard, are you meeting with investors via Zoom typically?
Yeah, we continue to always do client reviews. Keeping people posted in a very, uncertain environment, and continuing an environment that continues to move in odd ways. So I would say of the client reviews, I probably do 2 or 3 a day. I would say, 80% or 90% of them are now on Zoom. And still, a small portion and a little more every month are lunches or a coffee or something like that. But predominantly, people are getting more and more comfortable. I didn't know what Zoom was from Hot Rock a couple months ago. Now it's a huge part of my life. But at the end of the day, I can't wait for this pandemic to end and be able to, really look at, people face to face and have I think a more robust conversation. But for now, this works.
Mm-hmm.
It communicates. It helps people still understand their investment profile.
Well, because we have time, and I'm going to actually ask this question. Someone who has remained anonymous has put out. Yeah. Well, hey.
I like people tell the names. Tell the names. Who's out there?
It is what it is. But they just basically said they would have expected better downside protection. And so I'm sure that's not the first time.
In what? In my funds or in all funds?
I think
in what
yours.
I do?
Yeah.
I think that's a very good question, and that's a question that's been asked for by many people. I think that when you look at our experience, for example, which we had obviously a large drawdown in March, a significant amount of it was the fact that there was a liquidity gap that was created for a very short period of time that was, that really couldn't have been protected for in that moment of time. And so and that's a large part of it because we mark to market, and the marking to market creates this distortion. Distortion is an opportunity, but distortion creates this reality of a price at that moment in time. So what we've done actually is look at our history of our 11 years of how